My name is Victor Norman, and this is the Insider's Guide to Real Estate. Today's subject is home mortgages. If you're well employed, you have good credit scores above 700, if you've got more than 20% down to put on a home, finding a home mortgage may not be so difficult, or so you might think. If you're new to the world of work, if your credit scores are being dragged down by some pretty substantial college loans, and you don't have much money to put down, all is lost, or so you may think as well. To help clarify all this and to explain to us some of the changes that have taken place in the mortgage market over the past several years, both in the industry and on the regulatory side, is a true mortgage professional, Chari Goodman. Chari has been a lender for over 30 years. Presently, she works for Prime Lending in Concord as a senior loan officer. Please join me in welcoming Chari. Good morning, Chari.
Hi, good morning. Thank you.
Good. So let's start right off. I'm a consumer, and I've got a lender who gives me a good mortgage rate, good terms. Do I really care who's lending me my money? What are the different types of lenders, and why should I be concerned?
Okay. Well, you don't need to be concerned. Most lenders these days are direct lenders. The days of the mortgage brokers are pretty much over, and what that means is that whether it's a bank or a mortgage company, the people that are doing the lending have their own ability to make a decision of whether or not you should get the loan. So from a consumer's point of view, there's not a lot of difference. It's way more important to work with someone that you trust, that returns your phone calls, and that has some experience. So it shouldn't matter particularly.
Okay. All right, so it's really driven by someone you trust and feel comfortable with.
Right.
So right now we live in the world of the internet. That's where everybody is. Whether you're a first-time home buyer or someone who's thinking about downsizing, we're online, and we're looking there, and we're finding the house that we think we might like, and at some point we think about, well, maybe I ought to talk to a lender. But you're here to tell me that's really not the first step people should take. What should they do first? Okay,
the first thing anybody should do when they're thinking about buying or selling or anything is to talk to a mortgage professional. And I recommend that you get a referral. The internet's great as a resource to get information, but I recommend you get a referral from your realtor, from a friend or family, to get with someone that you can talk to and that you can trust. And you sit down with that person, or you do a phone call with that person right off the bat and just explore the options based on your individual circumstances, because it's just, there's a lot of options, and many people don't know all the options. The rules change constantly, and we went from being able to lend to anybody to then the guidelines got very strict when trouble happened in the finance world, and now it's back to many more options for many more different kinds of people.
Okay. All right, so we know in the real estate business, we know that the average consumer might spend a year online before they actually get serious about buying or selling. But do you mind if I call you up and say, Chari, I'm a long ways off from buying a mortgage. It may not be until the spring or maybe after that, but I'd like to get started. Is that something you're comfortable doing? Most lenders are comfortable with?
Yeah, I actually recommend doing that right away. Sometimes there's things on people's credit report that they don't know about. Sometimes there's things that they can do if they have the time to get their ducks in a row, basically. So I recommend, and there's no cost or obligation talking to a mortgage professional at the beginning. There's no cost to the consumer at all. So to get with someone, to have somebody look at your credit, talk about your income, your assets, your liabilities, what payments you're comfortable with, to get all that figured out early, or even somebody that's not a first-time buyer, even somebody that wants to downsize or wants to move up or wants to buy a second home or an investment property, or people who say, well, I don't need to sell my house, I can buy without selling. All of those things, you need to know what you're dealing with.
Okay. Well, I think you hit on something that most consumers nowadays are online, and they think they've got everything figured out. I know I get emails all the time from companies offering to give me my credit score. So there's one piece that I need. I can just go to the internet, use one of those services, and now I know my credit score. What's the problem with that?
Okay, so credit scores there's 3 credit bureaus, and each person has a score from each company. But they're done on different scales. If you're going to buy a car, or if you're going to open a credit card at a local department store, or if you're going to buy a mortgage, there's different scales, and there's also a consumer credit score scale that's different from the industry credit score scale. Now, you don't want to be getting your credit checked by a lot of people a lot of times, but when someone's starting this process, I recommend they get their credit checked by a mortgage professional early on to see what's up.
So why don't I want to get my credit checked frequently?
If you get it checked, every time you get it checked, the credit bureau brain thinks that you could possibly be taking on more debt. And so it rates you based on that, and at a point, the score can actually go down from opening up too many cards or having too many inquiries, because each time it thinks you can now be borrowing more money.
Okay. All right, so generally, what's a credit score below which I would have real trouble getting a mortgage?
There's a wide range. 620 is pretty much currently towards the bottom of the scale.
Okay.
Now, that doesn't mean somebody can't get a loan below that, but that's kind of where you don't want to be above. And then every 20-point increment can make a difference in your interest rate. So again, there's plenty of things that we can do to improve your score if we know what the reasons are that you have that score.
Okay, give me some examples of things I might do. If I come to see you, I've got a low credit score, and you give me the bad news, what can you tell me to help?
Okay, one of the things that most people don't know is whatever the limit is on your credit card, let's say it's $3,000, you should not charge above 1/3 of that. So if you keep your balance to 1,000 or below, if the limit's 3,000, you'll have a much higher score. If you max it out, your score will go down. And it's almost even better to get your limit increased but keep your balance low. That will still give you a better score.
Okay.
So
if a young person says, well, I should be great, I don't even have credit cards, that's not necessarily
That's
a good
another
thing.
bad thing, because we need to establish a track record. So we look for 3 lines of credit for 2-year history.
Okay. So you would expect, as a consumer, I would expect a competent lender to know pretty much all the ins and outs of credit score.
Absolutely.
Okay.
And there's crazy things that happen, like sometimes you've moved and the credit card bill didn't catch up with you and you owe $37 to some store, or you might have you might be a junior and your parents' credit may be on your report. There's a lot of little things like that, and we can fix all that if we can identify it early.
Okay. So I was surprised to find recently a car loan on my credit score that I had no idea that I had an outstanding car loan, but then I realized I had co-signed a loan for my daughter.
Right.
And so that appears on my credit
Absolutely.
score as well. So it is a
On
complicated proposition.
Right. But again, information is what gives you the ability to make a
Okay, so I met with you, and I've got a credit score now that's going to get me a loan. So when I called real estate agents, they asked me a question: am I qualified? Am I pre-approved?
Right.
So I can go online and get a pre-approval, I think. So is that valuable, or what should I really be doing? Okay,
so it's fairly competitive out there for the good properties. And so most realtors want to have a pre-approval letter from somebody that whose name they recognize or who know is reputable, because the ones that you get online don't normally require very much documentation. When we do a pre-approval, well, first let me say there's pre-qualification and pre-approval. Basically, those terms are interchangeable. People mix them up and think one's different than the other. I say pre-qualification is a phone call where you say, I make this much money and I have this much debt, how much can I afford? But in order for me to issue a letter to someone to buy a house, I have to see their pay stubs, their W-2s, their bank statements, their credit report, and do a real evaluation of what they can do, because then when they take that pre-approval letter, that gives a comfort level to the realtors, to the sellers, to the brokers on the other side, that this person knows that they really can get a mortgage.
So I can say, from my experience in a competitive market, having a strong pre-approval letter is an advantage.
It's a very big advantage. And most realtors won't even take people out to look at houses unless they know because people don't really always have a good sense of what they can afford and what they can't afford.
Okay, so let's talk about different types of loans. What can I do if I'm looking at, I want to get the lowest possible interest rate. I need to get a low interest rate so that I can qualify for a higher priced home, and
Right.
I know the price ranges in the community where I want to live. So what are my options with respect to types of loans?
Okay, so there's several factors. First of all, there's down payment. There's a new program rolling out that only requires 3% down. We have a 3.5% down, and then from there all the way down. So that's one of the things that we would evaluate right off the bat is how much money, what are your resources, how much money do you have to put down, and then we go from there. There's fixed rates, there's adjustable rates, there's renovation loans if you find a fixer-upper, there's government-backed loans depending on, again, different factors. And this is another situation where your mortgage professional will help you.
Okay. So why wouldn't I want to get the lowest possible rate for the longest possible term, like a 30-year mortgage? Why wouldn't I want to do that as a consumer?
Well, actually, that's the most common type of loan. But if you know that, well, it takes some crystal ball, some looking into your crystal ball. If you are maybe first married, first-time home buyer, don't have a family yet, you just want to get into the real estate market, but you don't plan to stay, as opposed to somebody who has a family and knows that this is going to be where they want to raise their kids. Or sometimes I have people that are older and plan to pay off the mortgage in a short period of time or plan to leave the area. So most people like the 30-year fixed rates because they're secure and rates are still at historic lows right now. But again, it doesn't fit for everybody, so that would be something, again, to consider.
So let's say that I thought I was only going to be in the area for a short period of time. I got a loan for a short period. Then my circumstances changed. What's involved in converting that loan? How would that work to get into a 30-year mortgage?
So an adjustable rate, the way that works is it's fixed for a certain period, like 5 years or 7 years or 10 years, and then after that it becomes, it changes every year. The rate changes every year, but it's still a 30-year loan. So you don't have to do anything, but if you decide you want to fix it, then that would be a refinance situation. So you would then come back to me and say, okay, now we want to change to a different type of loan. There's a lot of reasons why people refinance. This is one of them. And then we reevaluate the situation. We look at, what you owe, what the house is worth, and then we...
So there'd be an expense associated with that?
Sometimes we can do it with no cost. It depends. There's trade-offs. There's always going to be closing costs because there's people that have to be paid and there's fees that have to be paid. But you can choose between the lowest rate with closing costs or a slightly higher rate with no closing costs. And that's, again, always an option based on your circumstances.
Okay. Now, there used to be something called a prepayment penalty, but that seems to have gone away.
Those are gone.
So that's one thing a consumer doesn't
Right.
have to worry about.
Doesn't have to worry, not in this state anyway.
And then closing costs, I know it depends on the size of the loan. There are many variables, but just generally speaking, what can consumers look towards?
Well, it's thousands. It's a few, $2,000, $3,000, $4,000, depending on all the circumstances. Plus, when people are purchasing a home, they have to prepay the first year of homeowners insurance and they have to prepay a few months of their real estate taxes. So I like to tell people to set aside a cushion. Again, depending on the price range, it's hard to say a number, but I would evaluate it based on their price range and give them a cushion of which they can set aside. There are times when a seller can pay closing costs. There's times when you can finance the closing costs into the loan. So if people are short on cash, then we figure that into when we're looking at the best option.
All right, so let's go back to first-time home buyer. In this market, first-time home buyer typically is not going to be looking at a freestanding single-family home. They're going to be looking at a condominium. So I've come to you, I've gotten pre-approved, I've got my financial situation to the point where I'm very comfortable with a mortgage. Now I start looking, using a realtor, of course. And I find a condominium that seems to be within my price range, that is within my price range and within my mortgage limits. Am I home free at that point?
Well, I wouldn't say you're home free because in a situation with a condo, in addition to you being approved as the buyer, the condo has to go through an approval process.
Okay, let's talk about that.
Okay.
What is exactly
Okay,
does
so
that
a
mean?
single family home is not like that. You just buy the house unless it's not in good shape. But for a condo, the lender wants to see that it's a healthy condo. And so there's certain things that they look at. when I say healthy, they don't want one person to own more than 10% of the units, because if that guy gets in trouble, it could affect the whole place. They want there to be reserves in the budget, which means if there's maintenance that has to be done, they want there to be money set aside. Whether there's money in the account or not, they want there to be money budgeted for that. And they want more owners than renters in the complex, because again, historically, when people live in units that they own, they take better care than if it's more renters. However, we can get exceptions for any of these items. So just because one of those things may not be true in this particular condo, it doesn't mean they can't do it, but it's information that we need to get on day one. If somebody's going to make an offer on a condo, I ask on day one for information about the condo, because we have to make sure that we can lend in it, and also they want to know for resale value. The people want to know when they're buying, is this a good investment?
Okay. So when you say you look for this information, you look for some documents, where does the consumer find those documents?
Well, normally the lender deals directly with the condo association or the management company. The realtor also should know what's going on with it. So the listing agent would be the person that would be my first stop to try to get information.
How about a condominium that it only has a small number of units,
Yep.
2 or 3 or 4 units? Is that problematic?
Those are great. Those are often great because the people normally live there and normally, are involved. Sometimes one person would be a trustee or somebody that would handle the insurance, because a lot of times in those small units, the only thing that they share really is insurance and maybe some lawn mowing, snow plowing type of thing. So it's not a problem. It's just information that we have to get.
Okay. So now we've talked about regulations and standards and criteria. Who is setting all these standards?
So there's government agencies. Fannie Mae and Freddie Mac are the ones that most people have heard of. And the way it works is these agencies were set up by the government to regulate, to keep the guidelines standardized between different lenders, and to make it so that people knew what they needed to do to be able to get a loan and to be able to qualify for a loan. It used to be, like we were talking about, It's a Wonderful Life, when the guy goes and just...
George Bailey
gets a loan from the... So those days are mostly gone. There are some small banks out there that'll, work with people, but for the most part, everybody has to meet the same standards. And then a lot of lenders will add even stricter standards, we call them overlays, in addition to the Fannie Mae and Freddie Mac guidelines. But again, there's pretty much, if somebody's a qualified buyer, there's ways to get around it, and there's certain lenders that will do loans that other lenders won't do, which again is why I recommend you go to a mortgage professional who can help you sort that out. We try to always find a way to get it done for the customer's best.
Sure. Let's go back in time. The lending standards were apparently seem to have been a lot looser in 2008 when things, the subprime crisis that we've all lived through. What really, in your opinion, what really was the problem back then?
So what happened was, from when I started in the business many years ago, it was you had to qualify for the mortgage. You had to be able to prove with documentation that you made a certain amount of money and that you had a certain track record and that you could pay off your mortgage. And then gradually, and I don't know exactly why, but gradually the requirements got looser and looser, and we did no income verification loans where people could just tell you how much they made and tell you how much money they had in the bank. And the lenders would give them loans. And it fell apart because a lot of people defaulted on their loans.
And many of those loans were adjustable.
Some were adjustable. We had loans that were interest only, that people didn't even have to pay back the principal right away. We even had loans the other way around where you could pay less than the interest and it would add on to the amount you owed. And then the property values decreased in some areas, and so people owed more than their house was worth, and a lot of people defaulted. So then they went back to super strict. And everybody had to show everything again, but to almost an extreme. So for an example, if someone is self-employed for less than 2 years, it used to be it didn't matter, then it mattered. Now it still matters, but there are ways to work with people like that and other types of situations like that.
So do you think the pendulum is kind of swinging back to...
It's getting closer back to the middle, where it's not just based on common sense. You still have to have something. You can't have a brand new job and no money in the bank, and you're going from paying $800 a month rent to $2,500 mortgage payment, and you have no money to put down. I mean, it has to make sense, but if you're strong in one or two areas, but maybe weak in another, there are oftentimes ways to make it work.
Okay, so it really is important to have this kind of personal relationship between a lender, and even though it seems to be very mathematical, it seems like there still is this personal aspect to it that is important.
Well, you want somebody that's knowledgeable because there's a lot going on in the business. We get credit policy changes all the time, every day. We get different changes. They're lightening up on this requirement, they're more strict on this other requirement, or there's new programs rolling out, or there's new lenders that are coming up with different things that they can do. So you really need to be working with someone who knows about this, and also your situation might change. For example, in the past, I'd say 5 years, we're a lot more concerned about people's job stability. There were years where we never even talked about that, but then things changed. So people can change jobs during the mortgage process, but they need to be in touch about it because we verify whether they still work there.
And the verification continues right up to
the
closing,
end.
basically.
Yeah. We call within 2 weeks of closing to make sure you still have a job, and there are times when people don't.
Okay, so are consumers caution that even though they may be pre-approved, even though they may have a contract to purchase a home, they still have to get to closing.
Right.
And so what are the things that lenders should avoid doing between that time that they've signed a contract and the closing?
Buyers, they should avoid, well, I would say don't open any new credit. Don't go out and buy all your appliances and furniture for the house before you close, because we are going to check again. If you change jobs, be sure to let me know. Don't borrow money or move a lot of money around, because we verify all of your source of funds, not just the money that you have, but if some large money comes in, some large amount comes into your bank account, we need to know where it came from. And people say, why do you care? Well, we care because if you borrowed it, it could, and you have to pay it back, it could affect your ability to pay us back. So a lot of things that we scrutinize, people don't understand. And the most common questions I get is, why do you need that? And why is it taking so long? Mm-hmm. And the reason is because we're lending a lot of money, and we want to make sure we're going to get paid back. And also, we don't want to put people in a position where they're not going to be able to succeed. You know, we don't want to do that to people.
Sure. Yeah, that's right, and I think that makes a lot of sense. That despite some of the problems associated with the stricter standards that need to be corrected, at the end of the day, you don't want to give someone a mortgage that they can't afford to keep up.
Right. Right.
So interest rates are at historic lows. Right now they've been low, defying predictions even of a year ago that interest rates would be going up. That hasn't happened. Where are they headed? They can't stay this low, or can they?
Well, that's the million-dollar question. The predictions that I've heard for next year are that we're still going to be in pretty good shape. But the fact of the matter is, rates are what they are. So again, if people are going to be getting pre-approved and they say we're not going to buy for a year, I like to do a conservative estimate, and I say, well, if rates are this, you can afford this, and if rates are that, then and give people a range. Because we can't control it. We don't know what it's going to do. The whole world economy affects our interest rates, and there can be daily swings too.
Sure. Okay. All right. So what we have here, Chari, right now is a letter from one of our viewers concerning mortgages, and I'll read it. And
okay, great.
See if you can give me your answer. The viewer writes, can you please clarify for me the positive and negative reasons why a reverse mortgage might be a good choice for my wife and I? We are both getting close to retirement. Our budgets will be tight, and if we can reduce our payments somewhat, it might be a help. So tell us in a minute, what's the good and bad of a reverse mortgage?
So the great thing about a reverse mortgage is it can help people stay in their homes. And there's several different ways you can structure it. Some of it includes no payment, or they can actually give you money. The only downside really is that there's cost to it, which you don't really pay, but it comes out of the estate. So if you're worried about leaving a lot of money to your kids, this might put a little ding in that. But otherwise, it's a great option for many people.
All right. So the effective interest rate on a reverse mortgage compared to a standard mortgage?
It works differently, and it depends on some other factors. So
we could do a whole show on reverse mortgages, and we might do that.
It's a great option it's a great
Definitely
option for
worth
people to
considering.
explore. Right.
Okay, in a minute we have left, what's your final words of wisdom for our viewers?
Final words of wisdom is speak to a professional. Talk to somebody early. There's no downside to talking to somebody, and then you can decide if that's a person that you want to work with when you're time to do it.
Okay, so there we have it. Thank you very much, Chari, for joining us.
Thank you very much.
And that's our show. Thanks for viewing The Insider's Guide to Real Estate.